As of the making of this video, the entire stock market is currently in bear market territory. The S&P 500 is currently down more than 10% in just the last 5 days, and it's down more than 22% for the year. A lot of analysts and so-called experts are predicting that things are only going to get worse this year. And even though I'm often skeptical of these people, I think when we consider inflation and rising oil prices, I think it's a pretty easy call that things probably are going to get worse. How much worse, I don't know, but almost every sector from REITs to consumer staples have been negatively impacted this year. But there is one holding in particular that's continued to see some really impressive growth in 2022, and all the while offering investors a ridiculously crazy annual dividend yield of more than 36%. In fact, as an added bonus, it actually pays monthly dividends as opposed to quarterly or annually. The fund I'm referring to is the Credit Suisse Crude Oil Shares Covered Call ETN, ticker symbol USOI. This is an exchange-traded note launched by Credit Suisse back in April of 2017. According to their website, it represents long positions and comprises of derivatives such as options on the shares of the United States Oil Fund. This is in some ways going to be a follow-up to a video I made last year in which I talked about buying shares of this back when USOI was trading at $5.11 per share. Since then, the price of USOI has grown by about 14% and has continued to pay some exceptionally nice dividends. As much as I'd love to stand here and say I made this pick based on my own ingenious mathematical calculations and foresight, the honest truth is that it was just honest luck. I had no idea that there was going to be a war in Ukraine and that oil prices were going to skyrocket like they have. But I was confident that it wasn't going to collapse. I do regret not buying more shares back when USOI was much cheaper, but as I'm going to discuss, I'm not rushing to make USOI a very sizable portion of my portfolio. But just by looking at this fund on the surface, there's a lot of things that make this fund look extremely attractive. Looking at their dividend distribution history over the last year, we can see that it's been trending upward. It doesn't pay the same amount every single month, but it's been growing over the past year. If you invested $10,000 into USOI when it was trading back at $5.11 per share, you'd have 1,956 shares, which means you'd be collecting $494.67 in dividends in just the month of June. That is a ridiculously high amount of dividends that's unmatched by any other dividend investment I've ever come across. So how on earth does USOI work, and how is it able to pay investors these crazy dividends? If we look at this notes prospectus on their website, we can see the underlying index is the Credit Suisse Nasdaq WTI Crude Oil Flows 106 Index. According to that index's description, it says it adopts a covered call strategy that seeks to replicate operating a monthly covered call income strategy on an ETF on WTI crude oil, maintaining a long position in shares of the United States Oil Fund LP, ticker symbol USO. In other words, USOI generates all this income by writing covered calls on USO, which is an ETF that attempts to track the price of West Texas Intermittent crude oil. USOI then passes on the premiums earned from these options to shareholders on a monthly basis. If it sounds familiar, it's because it sounds similar to what covered call ETFs do, like QYLD, RYLD, and XYLD. All of these funds follow a similar formula that results in investors getting massive payoffs every month. Obviously, I've talked a lot about these kinds of funds in the past because I love the huge dividend payouts that covered call funds provide, and choosing to reinvest your dividends creates a massive dividend snowball effect that I find really addicting. But this strategy can have its downsides. If you expand the share price history of USOI back to when this fund was initially launched, you'll see it suffered from two big share price drops. The first occurred back in October of 2018, and then more noticeably starting in 2020, slightly before and during the pandemic. Back then, the share price of USOI was at nearly $22 a share before plunging all the way down to less than $4 a share in October of that year. If we compare that to USO, we can see that the two funds mirror each other in terms of losses during that same time. This is probably the biggest downside with covered call funds. When the underlying fund or index increases in share price, the covered call fund will see a moderate amount of increases in terms of its share price. But when the underlying asset drops in price, then the covered call fund experiences the exact same amount of declines as the index. But the reason why this fund has performed so much better than QYLD and all the other covered call ETF funds is because of soaring oil prices. QYLD writes covered calls on Nasdaq 100 stocks, and RYLD writes covered calls on the Russell 2000 index, both of which are down for the year. But USOI writes covered calls on oil, which has exploded in 2022. In fact, pretty much the entire oil industry has been performing exceptionally well this year across different holdings besides USOI. A lot of the big players in oil like Chevron and Exxon have seen their share prices grow by more than 40% this year. Two stock types in particular that have done really well in 2022 would include royalty trusts and some master limited partnerships. Basically, almost anything that has to do with oil has been performing really well this year. Royalty trusts are a type of corporation that own royalty interests in oil fields and wells, whereas master limited partnerships are unique companies that are basically publicly traded partnerships. The overwhelming majority of MLPs are involved in the energy sector to some degree. Both types of investments have their pros and cons. Royalty trusts are significantly more impacted by oil prices, whereas master limited partnerships do have more stability. The amount of dividends you receive from a royalty trust changes every month, whereas MLPs are able to provide a little more stability in their distributions. But master limited partnerships do send their shareholders something called a K-1 tax form, which you're required to fill with your taxes and can be complicated if you're not using tax filing software or the services of an accountant. According to ETF.com, shareholders of USO are sent a K-1 tax form at the end of the year. However, shareholders of USOI are not sent a K-1. I can confirm that I did not receive a K-1 last year for holding USOI in my portfolio. But another important thing to note is that this is not an ETF, it's an ETN, otherwise known as an exchange-traded note. You might be wondering what an ETN is because in some way they do have some similarities to ETFs. You buy and sell them on exchanges just like any publicly traded stock, and they both track some underlying asset. Probably the biggest difference between ETNs and ETFs is that ETNs act more like a bond. All of them have a maturity date in which investors can hold until they reach that deadline or trade before reaching that date. Another really fundamental thing to know about ETNs is that they're unsecured debt notes issued by banks or other financial institutions. Unsecured debt is a type of debt that's not backed by any collateral. This is different from other high-yielding types of investments out there that pay shareholders large dividends. For example, mortgage REITs invest in or originate mortgage loans, which are a type of secured debt because they're obviously tied to real estate. Another example would be business development companies. These investments typically hold an overwhelmingly majority amount of secured debt. If a business a BDC offers a loan to goes bankrupt, it's possible that they could receive some or all of their money back if the business liquidates their assets to repay them. But in the case of ETNs, if the underwriter goes bankrupt, the whole ETN can potentially vanish, resulting in you losing all of your investment. But it's not only bankruptcy that can result in an ETN disappearing. That's probably the worst case scenario. The issuing institution has the power to call the whole fund at any time they want, and as a result, you can lose a lot of your investment if that happens. This exact same thing happened in December of 2021 with the Credit Suisse Mortgage REIT ETN, which was ticker symbol REML. The company made the decision to basically call the ETN, and as a result, the fund was completely delisted. If this happens to USOI, then investors are going to run for the exit and dump their shares, which could send the share price falling pretty significantly. It's apparently such a risky holding that one of my brokerage platforms does their best to try to discourage me from buying it. I get this pop-up window saying, "This exchange-traded note you're buying may use complex investment strategies and is therefore intended for only sophisticated investors who understand the risks involved." And then it proceeds to give me an overview saying ETNs seek to track the return of a specific stock, commodity, or currency index. They're unsecured debt obligations of the bank or other financial institution that issued them. They don't represent ownership of any individual securities. Although ETNs have a maturity date, they offer no principal protection and they may not pay periodic interest. An ETN's performance depends on a combination of the index the ETN tracks, the underlying securities in that index, and the credit risk of the issuing firm. Fees are typically charged, which can reduce the overall performance. And then this warning just goes on and you just have to click through it. From what I've heard, Vanguard isn't the only platform that tries to discourage people from buying this. I've heard that some platforms don't even allow you to buy it at all. Given the heightened risks of ETNs, this is one reason why I believe this fund should definitely not be something you invest in and then forget about it for long periods of time, like you would with a Vanguard or a Schwab Dividend ETF. Another reason why USOI definitely shouldn't be a passive investment is because its performance solely depends on the performance of oil. Oil is a very cyclical market, which means that there's cycles where it performs really well and times where it doesn't. It's very obvious that as of the making of this video, oil prices have gone through the roof this year, which explains why USOI has been able to provide not only a higher share price, but also increasing dividend distributions this year. When oil prices do start to fall back down, then both the dividend distributions and the share price are probably going to fall quite a bit with it. I should also take the time to mention that Credit Suisse has seen their fair share of controversies in recent years. Over the last decade, Credit Suisse has been fined billions of dollars by various countries for tax evasion, breaching sanctions, as well as playing a role in the 2008 US financial crisis. In fact, the only banker who was ever sent to jail for the 2008 financial crisis worked at Credit Suisse. The 166-year-old investment bank has been plagued with so many controversies, its reputation has been pretty tarnished for engaging in unethical behavior. Obviously, the choice is completely up to you if you decide to invest in this fund, but I had a lot of comments from people who wanted me to at least bring this point up about this company. If you do happen to be interested in investing in USOI, but maybe you're still concerned about dramatic price drops, one thing you could potentially do is buy shares and then put a stop-loss order on your brokerage platform. A stop-loss order is an order that you make that'll automatically sell your shares at a specific price you designate. So for example, if you buy shares of USOI at $5.90 per share, you could then put a stop-loss order at $5 per share. This means that if the share price of USOI were to plummet to $5 a share or less, your brokerage platform would automatically sell all of your shares at $5, and that can obviously help minimize your losses. Of course, you'd have to hope that someone out there will want to buy your shares at $5. If it plummets significantly lower than that, then it won't do much good. Additionally, stop-loss orders expire after 60 days, I believe, so you'll have to keep creating new orders. But ultimately, I think taking advice from Warren Buffett is one of the most beneficial things we can do in this situation. Warren once famously said, "Never invest in a business you cannot understand," which I think applies in this situation too. If you're still confused about what USOI is and how it works, I'd recommend doing more research on exchange-traded notes until you have a better understanding of them. Check out the prospectus on Credit Suisse's website. It has a lot of helpful information that you can use to better understand this ETN. Given the inherent risks of ETNs, I don't recommend that these take up too sizable amount of anyone's overall portfolio, if at all, if you happen to be a super risk-averse investor. I know it's a really compelling investment seeing how it's currently up for the year and it offers a massive dividend yield at nearly 40%, but the thought that the plug can be pulled is kind of an unsettling thought. But remember, regardless if you choose to invest in USOI or some other ETN, always diversify your portfolio so that in case the worst happens, you can still rely on your other holdings for dividend income. Always perform your own research and due diligence before investing in any type of publicly listed security. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching and I'll catch you next time. Take care.